I talk about three broad buckets when I talk about the business: the inorganic piece, a fifth drive of efficiency, and then the organic growth piece.
Today, my guest is my good friend, Rich Eknoian. Rich, how are you today, buddy?
Doing well, Al. How are you?
Rich and I got a long history. We actually met in 2000, okay? A mutual friend, actually someone that Rich was getting his MBA with, NYU Stern, a guy named Robert Metz. So if Rob ever sees this, we'll give him some props here. Rob was the son-in-law of Don Tribue being the owner and founder of the Tribue Company. He's a pretty sizable agency in northern New Jersey and ended up selling it to First Union when all the bank waves were going on. But Rob, knew that I was in the market to find a partner to help me on the finance side. And luckily enough, Rob introduced me to Rich. Rich was, definitely game. I think, Rich, you were working as the CEO or CFO, of a moving company. Once we got through everything, how it was going to work, we partnered up. And, I give you a lot of credit, Rich, for really helping me really get off the ground on the M&A side, because till then I was more of a finder, and I was, engaging with all these banks in the mid 90s to the early 2000s. I didn't have someone like you with your skill set to partner with. So, when you came in, it really was the evolution of the beginning of what my M&A career really was. But when you came in, you really helped me springboard it, and I'm totally indebted to you for that. I really appreciate it. Look at where we are now. You've built one of the best growth strategies in the country. And I like to say that, Sica, Fletcher, and what we built on this end is, obviously the leader in the space at where we sit. And, it's just very, very gratifying to me that we're here today.
I think, like most people in the insurance business, it's rarely a direct path to insurance. So for me, it was, back, as you mentioned, those days as the CFO of the moving company. It was a small business, and they had sold off a couple of businesses, and I got bit by the M&A bug. And some of the folks that were repping us through those transactions, I said, I want to be that guy. I'll be on that side of the ball as far as helping closely held businesses that want to sell. And kudos to Rob Metz. When I went back to MBA to help facilitate that move in my career. Rob knew you and your needs, and he knew what I wanted to do, and it was a great fit, and worked out really well. 2008, we didn't know when any deals were going to get done. Everybody kind of tapped the brakes when the financial world was collapsing around us. And to your credit, I'm like, I don't know where we're going to close that deal, and I got 3 kids and a mortgage, and I got to pay the bills. And you're like, I'll take care of you. And I was like, that didn't really feel right. So I'm like, no, I got to go do my own thing. That box was empty, by the way. I always planned on seeing the deals we were working on through, and that's exactly what we did, right? So it all it all worked out.
It was a great run because, obviously you learned the insurance brokerage business, and you added a tremendous value to me because I didn't have your skill set, nor was I ever going to get it. And, together we started building this thing and getting notoriety. And it, some of those people I can remember, and it was a very different environment back then, Rich. There was no real private equity backed brokers. Although, if you remember, we did really one of the first ones when we did Tannenbaum Harbor and Thesco with Olympus in 2006. Nobody was really utilizing private equity capital, like they have in the last 10 to 12 years. I give a lot of credit to obviously the Alliance of the World, who really were the poster child, and then Assured behind them. But, Greg Williams and Acrisure really, I think, were the ones that really hit this model to where they really got the entrepreneur's attention and really got the attention of these family businesses, which is what insurance brokerage is, and entrepreneurs, to where he created that model that catered to them rather than selling off. Because you and I, when we were doing this, we were selling to Hub, right? Our clients to Hub, right? USI, Brown, Gallagher, Marsh, those were the buyers. Those were the investors. And it totally changed what you've done. It is second to none. And it's not unrecognized by myself, who I like to think, has a pretty good seat at the table in this space over 37 years, but also others you've earned tremendous respect from. So, Rich, if you don't mind, why don't you give a little background and history and where world sits today?
Yeah, sure. I mean, I think we really do need to fast forward through the first, 9-ish years. So we bootstrapped the business for the very early years, and then in the Macquarie deal was transformative to us in that we had access to that capital, which gave us runway, which was new. I mean, usually our debt capacity would run out very quickly, 6 months or 12 months. And the Macquarie deal gave us some runway to keep running in the M&A for some period of time. But that too, ran its course, and we got tired of going out and refinancing periodically or that often, and we wanted to leverage the private equity world to help us with the financing and just help that going with their resources, so we could just focus on running the business, including the M&A piece of it. So we partnered with Charles Bank in April 1st of 2020. Significance of that date is, of course, closing our deal, but also it was really the height of COVID, and that the getting on the toast or the closing call there was the first time I ever dialed into a Zoom. It's amazing to think about now. It's several times a day, but it was, that was the first time on my IT folks saying, how do I do this? So I got download what? And it was great. I mean, it was really interesting thinking about that. I also had COVID. So that was, so Charles Bank got involved, and they really have handled the financing since. And they do a lot more. I mean, those private equity folks, when you're in with the right ones, you have their portfolio resource group or whatever they call them, accelerator teams, and they help in so many ways. And it's been awesome to have a partner and to think about it. And that's why I was a bit of a hypocrite talking to people about partnering with us and all the resources we could provide, and didn't really see the light to partner myself with someone that could help us. And it's been awesome. And they made quite a return in the first 3.5 years, and they wanted to cash some chips. So took us to market. Probably not the best time in 2023 based on what was going on in the world in the markets, but it was just the right time from the standpoint of where we were. So went to market, and we were able to get the deal done with Goldman October of 2023, and Charles Bank sold down half their interest. They're still invested in World, and now Goldman's invested alongside them. So we have the two sponsors, which has been working out just fine. They work really well together. Going through one of those transactions is quite a time commitment. So we never missed a beat. We kept it going the best we can, but recapitalization is a lot of work, and we feel really good about our partnership now with Charles Bank and Goldman, and we've been running really hard. And there's a good chance that this will be our best year ever of M&A. It's for halfway through the year here, but M&A is really heavily weighted to the last third of the year. The year always starts a little slow, regardless of whether there's tax changes pending or not. People seem to just want to do deals more at the end of a year for some reason. But I think we'll finish strong. But M&A is going really well, and the partnership with private equity guys is great.
You were about, I'm going to guess, 70 million-ish when you did your first recap in 2020, right in the heart of the pandemic. You're talking about 4 years ago, going on 5 years now. And the growth, everyone knows you're doing M&A. Everyone knows you're going through acquisition, right? Everybody wants to see it working. Talk about your strategy a little bit, Rich, and what the business looks like here, the breakdown of what World is, because it's very unique. So you've done a bunch of things, but from day one, you were an integrator. Can you talk a little bit about your strategy and what World looks like today?
So the strategy, as far as integration goes, has been the same since the beginning. Yeah, we did it. Our first deal, we integrated the TAM, the software. It doesn't really matter. The principle is the same, which is one instance of one agency management system in our P&C business. It's a different system for employee benefits, a different system at Novate, our wholesaler, and so forth. But in each case, we always integrate the data since the beginning of time. So that's been consistent. We've evolved, and then what we do with that data and dashboards and Power BI and those kind of things, and using AI now to for sales tools. And so that's a whole evolution, but the principle is the same on the integration side. So acquiring businesses is the given, or the thing that I'd say we are known for probably publicly. But that integration and then the efficiencies you're able to build up because of that integration is a big part of our strategy as well, the margin expansion. So highly automated, we offshore a lot, we automate, now we have a couple bots working in the system to do basic, redundant workflows. And I think the upside on efficiency and some margin expansion is huge. And you look at bringing a couple points to the bottom line, you multiply that by your valuation multiple, and it really is accretive to drive margin as well as the inorganic piece. Then the last piece then is the organic growth. And we have, a bunch of different levers to pull there, from just having the markets, or more markets than the targets that we acquire, providing a national accounts department that is awesome and can help folks write larger accounts just by giving them the resources and the tools to do that. Some niche expertise in a bunch of niches that we're good at, and extensive producer hiring, or client advisors that as we call them, hiring. So we're out to hire 200 client advisors this year. We're on target to do that thus far. That's a huge undertaking. A lot has to go into that, from top of the funnel, to talent acquisition folks, to training, to making sure they're properly mentored throughout the footprint, to give the best chance of success. So driving that organic piece is really the three. I talk about three broad buckets when I talk about the business with my team, which is the inorganic piece, driving efficiency, and then the organic growth piece. And then, that filters down to a lot of different aspects of each one of those. But, that's the basic strategy. It's not just M&A, but the other two parts.
So World looks full service today, coast to coast. I've spoke on these podcasts. I've said, we've been selling not just, property casualty firms and employee benefit firms into these things. Some of these things we've sold tax advisory firms, actuarial firms, auditing firms, of course, surety, anything that was outsourced before, becomes, because of that alignment of equity, which you're doing the same thing everyone else is doing. You're sharing part of your equity in the transaction, which is key, because that aligns everyone to do the cross-sell and be the expert and share revenue and share the successes together, which helps their growth in the way the deals are structured in these 3-year earnouts and so on and so forth. World today, very big on the retail side, but also pretty robust on the wholesale side. You made a big investment there. Also pretty robust on the wealth management side, which we know, Rich, 5 years ago or so was taboo. Nobody would touch it for the compliance, and you were all nervous about it. Now, if you're not doing it, and I think you once said to me, if you're not doing all these things, if you're not a wholesaler, if you're not a retailer, if you're not wealth management, you're not competitive. So you've kind of covered all the bases pretty much, and you have all the different verticals as well, not just the divisions. But if you could speak to that with the breakdown of what World looks like right now, that would be great.
Yeah, definitely. So look, we were in the wholesale business before the 401k business, right? So we'll start there. So Novate is our wholesaler, MGA, MGU, listed as the 8th largest MGA, MGU in the country by Business Insurance last summer. We've made about 20 acquisitions in that business. So we're in the process of knitting those together through an integration, same as we're integrated on the retail side. So kudos to Acrisure, 611 integrations. We're going through about 15 at Novate to catch up as far as integrating. And that's a huge undertaking. Can't imagine 611. So that's amazing. But yeah, Novate's same strategy, organic and inorganic growth. They have some great program business there. Very proud of the way that business is growing by double digits organically, which is awesome. And it's just been a great add for us. The first acquisition there was 12/31 of 2020. So wrote a business plan for Charles Bank, April 1st of 20. Said one of the things we wanted to do was acquire a wholesale MGA, MGU business to work alongside our retailers. And we got that done pretty quickly. The 401k business was a little bit more opportunistic. We had some 401k within our businesses that we had acquired, right? You buy a PNC business, they'll have an employee benefits business. Maybe they're doing some 401k. We had a handful of those, 4 or 5 million of revenue. When the opportunity came up for us to potentially acquire a large platform called Pension Mark out of Santa Barbara, California. So we were able to do that. It was very competitive. It's a great asset for an insurance broker to have. And that 401k platform today is about $100 billion of assets under management. So It's a big number. It's a top 5 platform of its kind in the country. It's also national in scope and a great addition for us. Every single PNC account or employee benefits account is a potential 401k client. We do all sizes through, again, on the stratification, the smaller business, a lot more automated the way that we handle those, but the platform is really second to none, and it's awesome. So then when you have $100 billion of assets under management in 401k, about 10% of that rolls out each year. And then those folks need wealth management strategies for the money that's now come out of their 401k, and whether they're rolling into an IRA or they're using it to live. That's a great opportunity to build a wealth management business alongside the 401k. So that's what we're trying to do through acquisition. We've made a half a dozen or so acquisitions in the wealth management business. That business is about $12 billion of assets under management. That $12 billion generates as much revenue as the $100 billion. That's just the way that works. Wealth management just generates a lot more revenue. So think about $10 billion out of 401ks to wealth management each year, and the revenue potential to grow a wealth management business. We're really excited about that evolution of that business. So it's 3 distinct businesses: World Retail, and then Novate, and then World Investment Advisors is now the brand with that 401k and wealth management business. And we acquire in all 3, and the cross-sell and the cross-pollination between the businesses in all lines is really, really going well. We think we're going to unlock something there in terms of where our folks work together, and really good momentum.
And Rich, the retail still represents your biggest chunk, I think, right? If you split it out percentage-wise.
Significantly. So of the 750-ish that you said as our revenue base, which is accurate, the retail business, the budget going into the year was like 540. And I say the budget going into the year because there's been acquisition in the first half of the year, right? So it's a moving number, but by order of magnitude, let's say 550 plus of the 750 total is retail insurance distribution. So the biggest piece by far.
Well, listen, that's your core and has been your core. You're adding these other divisions, which will take time to develop, but obviously they're not small because you still have another 200 million representing the 2 of them, and growing. And I think the fact that you have them is critical because it is one-stop shop nowadays. Okay, what we have seen a little bit more with, as far as the inorganic, as you say, or the acquiring, what we have seen is people are getting a little more select on really purchasing more of their core than other things because of the interest rates being high and everybody trying to protect their cash. The cash you have, bet on the things you do good, not on the things that you're taking a chance on or a risk on. And, listen, you still do that, and I see you have, but, I think that we're seeing that a little bit more, that people are sticking to their core business, and they're a lot more select in the M&A game. So that's a kind of a good segue into the market, Rich. I'd like to know, what do you see for World? Where do you see the market, for your peer groups, the peer groups above you, and for World? What do you see strategically?
It's really hard to say because you don't really ever, at least I don't, get a close look as to what was really going on in some of those deals. And what I mean by that is we see that, the headline multiple, and then, you talk to the bankers that were on the deal, and it says like, well, from the seller's perspective, the multiple is different, right? The buyer will publish something where they're building in additional cost synergies and tax credits and, whatever they build to make the multiple sound smaller, that helps their initiatives and what they want to portray in the marketplace about the great deal that they got. And of course, somewhere between the truth lies, right? But you don't really know where until you look at the sheets. I will say in our process, the multiple for our business fell where we thought it would when we started the process. That was 2023. Things change daily to some extent, but they certainly shifted in 2025. But we see some of the multiples published, and I don't want to name names, but a lot of times it's a minority stake where you find out that there was something inherently, there was something in the business that caused a bit of a discount. And I'm optimistic that multiples are holding steady. I know some of the headlines have come down a little bit, but there's nothing about this business that has changed in all the things that private equity folks like in terms of, being rather recession proof, and folks always need insurance. And we have our cycles too, but it's not necessarily tied into the economic cycles. It's Yeah, it's just the insurance capacity cycles, right, that drive pricing sometimes. So I'm optimistic that they've stayed, and I hope they have, because I got to tell you that the multiples on our targets sure haven't moved a whole lot, not on the good targets. Good businesses or that we're acquiring, multiples have stayed the same, even though it seems to be less buyers out there. I mean, it's always competitive, so it's not like there's too few buyers, but there's it seems to be a lot less. We're getting a lot more activity. So there's a lot of targets and a lot of activity to continue our acquisition pace. But the price of the assets that we're buying sure hasn't gone down. So hopefully our valuation hasn't gone down, or the arbitrage is evaporating. And I'm optimistic that that's not really the case when you cut through all the noise and the stuff you read out there, and what's going on.
Well, no, and Rich, I agree with you in a lot of ways, because I have a different view of the world too. And I think a lot of it's how you present yourself in the marketplace. I think a lot of these folks that go out and they have people to go out to multiple people, they devalue the business. It's not a smart thing to have multiple people involved. At the end of the day, I think that it's how you present, it's knowing the market and know who's really at the point where they're ready to really do something. Okay. There's a lot of people that will look. And listen, I brought more private equity money into this space than anyone that I know of in the last 10 years, let's say. Okay. Like I said, and most of the recaps we've done were people I brought the money into and we've invested in, so on and so forth. That being said, I do think that it is cyclical. I do think that a lot of the players now that have come out that are multi-billion, in revenue and really didn't prepare for what this was going to be like. Just assume that, whether they integrated well or they didn't integrate well or whatnot, their size and scale would carry them to the high value. We have not seen that recently. That doesn't mean that's what's going to happen to someone who's done and been thoughtful about integration, what now. But I will tell you, I do think some of the smarter private equity guys that I deal with, and I deal with a ton of them, are the ones that are getting ahead of it with the assets they have to try to prepare years in advance for the public offering. Because for you, maybe another sponsor, depending on the size. Okay, but it's hard to do just with one sponsor when you get big. So you're either going to have multiple sponsors, like some of the others have, USI, Hub, pension funds, all that good stuff, or you're going to have to think about going public yourself, and that's no easy task. Okay, just so you know, that's not an easy task to prepare to go public. If you prepare ahead of time, that's the goal. That's what you have to do. I think, a lot of people just think they're going to go public and when they want to go public. And we're finding out that's not the case, because look at two of the assets right now that I would think were two of the better companies, at least, two of the bigger ones, never would have thought that they'd be selling to publics. Okay, at this time. And maybe that's a strategy for you too. And maybe that's something that you have to look at, because it all be based on giving your shareholders liquidity. And when you start forgetting about your shareholders, that's when you get in trouble.
Yeah, I would say, I see that as my main job. As 3,000 people here that make sure that employees and clients and carriers, a lot of other things get done. But driving the equity value is the number one bullet, maybe the only bullet on my job description. So totally get that. Also understand, what it takes to be public to some extent, right? I mean, our CFO was previously a CFO at Aon, right? So that we know a little bit about that. That's where a lot of your controls are going to come into play from the standpoint of, a lot of the issues with being public. So we have some thought around what that takes, and we're not really thinking about it yet. We're not really gearing up for that. I do think we have another private equity deal in us, but I think with that, going into that, we're going to be like, okay, what's next to maintain liquidity for the equity holders here? And the thing about the equity holders here is the largest equity holders, or the largest group, are employees, right? So we're going to do what's best for the employees, and for all of our people, and for the business, and, our clients. And, we'll see. I mean, the market's going to dictate to some extent. Read something the other day where there are 5 or 6 IPOs expected in the next 12 to 18 months in the insurance brokerage space. That's a lot. I mean, but there's probably not enough insurance brokers that are public right now in terms of the appetite, for that asset as a recession-proof financial services or financial sector asset. So it's interesting. We need more now, but there's a lot more coming out. And what's that balance going to look like a year from now? Nobody knows. But
Nobody.
was mentioned.
Just got to take a day at a time. I tell everybody that's what we do. And as you said, Rich, when in 2008, when you moved on from partnership with me, there was questions around survival and things of that sort. But I've been through many cycles. Okay, and I just put my head down and I just figured out how to stay ahead of everybody. Is what I've done and we've done. And obviously the combination with Mike and Fletcher and Ray and now the robust team I have and great team I have, best in the business by far. And it's not just me, it's the people around me. That has always driven us to stay ahead of the curve. And I do think world is positioned very well right now as one of the premier acquirers at your scale and your size. Some of the ones that are getting too big, part of the problems they have is when you get too big, that sexiness of the equity flip, if they've done it 2 or 3 times, 4 times, isn't as sexy anymore. And, when they were 750 million or 500 million or 300 million, they were, the fair-haired boy. Okay. They were the ones that were winning a lot of deals because there was still runway on the equity. So I do believe, and I agree with you, that you have runway at World for sure. Certainly, if you hire Sica Fletcher next time, you'll definitely get the right next sponsor, right? And not that you haven't done a great job so far, but I say that, jokingly, because I firmly believe that the next recapitalizations we're going to do, and there's several that are going to come up here, we feel very confident that we'll still be able to get the values on the way we run the process rather than flooding the market. And, in previous podcasts, I've done one particular with a private equity group. Some of these are going to be not only with CEOs like you, but private equity guys getting their perspective on it, because you're right. There's no way insurance brokerage is not still the darling of the private equities. They love it. It's recession-proof. It's high margin. It's residual. You need it product by law, most of it. So, yeah, they still love it, but they're just being a little more cautious. And the reason they're a little more cautious is because of the interest rates going up. When the interest rates were down, it was the Wild West, Rich. We went out to 12 people. We got 12 offers. Now, okay, you go out to 12 people, you're vetting out to get half of that. But the ones that are the lead players, so you don't waste people's time. And, we're going through a process like that right now with you on a deal. And you understand what we're trying to do and try to be fair to everybody. But I do believe this is cyclical too. I believe that people now are seeing certain things, but it's supply and demand. Somebody wants it bad enough, they're going to do what they need to do. And the beautiful thing with the private equity capital is they all have money they need to spend. Okay, these guys don't invest in these funds for you to sit around for 6 months, 8 months, 10 months, 12 months, a year, whatever, and not spend it. So, you got to just hit the right hot player. And that's what I've been able to do. The majority of our recaps, Rich, were one-offs. We didn't run a big process because the player, a good fit, they'll pay the price, they want to be in the business. And I think, that it's all how you run the process. It's amazing what you've done, with the addition, I like I said, of both Charles Bank and Goldman Sachs, obviously marquee names. You're a smart guy, you always were. Like I said, you really contributed to my success of building my business. And then, and I'm indebted to you and I thank you for it, and we have a great friendship and relationship. I know your family for years and my family, and it's wild that we're here at this point in our careers and our lives where you're at the top of the mountain with this thing and with World. And, I think we built a pretty damn good business on this side of the business. And like I said, I'm indebted to you and I thank you. And I like to think that, early on, getting in, learning the business, understanding, the insurance brokerage space, the 8 years you spent with us or with me, really, was something that really helped you propel your career, into Frankel, into World. And, I'm not going to say I taught you everything I know because you always were so smart. I didn't need to do that, right? But I think that you've done an amazing job. Once again, I'm very proud to be involved with you and help World along the way. And I hope to be involved, till we're both stop doing this, Rich.
Yeah. No, been a great partnership. Definition of a partnership, right? I mean, it's mutually beneficial. So I definitely appreciated learning the business and learning meet a lot of great folks with you. And it was a bit of an evolution when you think about the banks to the private equity groups. Now maybe back the nationals getting more involved. I think I think the private equity groups haven't really gone away. They're just lurking. I mean, I don't want to get in the weeds. I'm a tax guy by background, and you think about the interest rate limitation, which is going to get better again, a little bit better in 2026 with the definition of EBITDA or taxable income. And so that's going to get a little better. I'm hopeful that interest rates will come down. I think all indications are that, we'll get a cut here in September. So I think some of those dynamics are swinging, the pendulum swinging back a little bit, but I don't really need more competition. We've been fine through this. So, we figure it out. And, but yeah, it's been a great run. And, but I feel like we're in the, still in the early innings here. It's amazing. We are actually in 38 states. It's one of the questions that you asked there back a little bit. A lot more geography to cover. We're open to being in Canada. We have an operation in London. So, between the three businesses and their various geographies that are open for expansion, there's a lot more that we we can do and we should do to continue to build this business. So the future's bright, exciting, and a lot of places to go and to get things done.
Well, I like I said, I think you're in a great spot. Your World is positioned excellent. We're happy to do what we can to help you along. And, once again, it's funny you bring up that, people you met while we're together, and some of those people are some of your leadership, right? That you have, and, people that we grew up with as we built this M&A thing. It's funny. It's gratifying because they're all good people. And we all know a lot of the same people and whatnot, and it's helped both of us to get where we are. So, Rich, I can't thank you enough for joining today. I've been looking forward to this. I hope this was as good for you as it was for me, as they say. But this was excellent. Unless you have anything that is pressing that I missed, I thought this was outstanding. And best of luck and continued success with World. And thanks for joining.
For the opportunity. It's great to reminisce on some of the names that you dropped there early in the conversation. A bit nostalgic, but thanks for having me.
All opinions expressed by the hosts and guests are their own and are not necessarily those of Sica Fletcher. This podcast is for informational purposes only and should not be relied upon as professional advice. Sica Fletcher employees and clients may have positions in the firms discussed in this podcast. Any information provided is subject to change and does not constitute an offer to purchase or sell any financial product. Sica Fletcher LLC does not underwrite securities, nor advise on, nor affect transactions in securities for the account of others. For more information about your unique situation, please contact Sica Fletcher or visit us at www.sicafletcher.com.